Okay, hello. Welcome to the special edition of This Week in Intelligent Investing. It's a little different than our typical. I'm sitting here with Isaac Schwartz, a good friend of mine who I actually met at the Manual of Ideas Idea Week 2019. We went from there to become good friends. We did a diligence trip together not long after, got to know each other even better, and reconvened at Idea Week 2020. Interestingly, we live not far from each other in the US, but it took a trip to Switzerland to really meet and get to know one another. Isaac is one of my favorite managers out there. He's a really interesting guy, really worldly and knowledgeable. He could go seamlessly from covering Turkish banks to disruptive innovation in food delivery, and amongst other areas. So I think that's really a fascinating array of topics. I think it's kind of informed by Isaac's experience, having lived 1 year in Singapore, 5 years in Hong Kong, and 1 year in Istanbul. So not many people have experienced that many different regions. And, it's really, really impressive how that's informed Isaac's investment strategy, philosophy, and portfolio composition. One of the investments in particular that I've really been impressed with is Ocado. It's a really interesting company, really interesting environment. And I think it would be helpful to talk broadly with Isaac about delivery, food delivery, and logistics, and then maybe get into some specifics about Ocado itself. So welcome, Isaac. Thank you for joining us here today.
Thanks for inviting me on, Elliot.
Very excited for this. Maybe start broadly about your interest and experience in food delivery and logistics.
I got interested in food delivery a long time ago because I remember when Seamless launched in New York in the late 90s, and I remember getting together with friends and ordering burgers from Nectar Diner on Madison, and we have to have been amongst the first users of the service. It was just a few months old. In terms of its incarnation with as an investment with Grubhub, of course, Grubhub merged with Seamless before they went public a dozen or so years later. That was a little bit more of a winding road. In 2004, I was finishing my last year at Penn and working for a family office in Philly. And they were looking at doing the Series A round with Net-a-Porter, Net-a-Porter.com in London. And I did work on the company, wound up getting sent over there to spend time with the founder and CEO. And it was an early bit of insight into the importance of having just a totally dedicated architecture from the ground up, looking to solve one sort of a problem, as opposed to, retrofitting existing infrastructure that was out there. Our journey with Net-a-Porter wound up being a really interesting one because that summer, when the family was looking at doing the investment, the big issue was, it's a tiny market, and there's another guy doing it, Ukes.com in Milan, Italy. So, it's such a small market and there's already competition. Anyway, both companies became hugely successful. In 2010, Richemont, sort of a distant third conglomerate in the luxury sector, after LVMH and Kering, Richemont owns a lot of Van Cleef and Arpels and Cartier and a bunch of brands. They acquired Net-a-Porter, and around the same time, I think in 2009, Ukes went public on the Milan Stock Exchange, which is a sleepy little market. I've invested for 15 years in a lot of emerging markets and Southeast Asia. And anyway, a sort of fringe Eurozone market like Italy is just as quiet, just as low volume outside of a handful of the most traded companies. And anyway, Ukes was focused on a slightly different market segment. They were more of clearance merchandise, still looking to help brands preserve image and keep pricing at a good level and not piss off established distribution channels, but distinct from Net-a-Porter, which was an innovator in really just taking the full price on-season merchandise offering of big luxury companies, Armani and you name it, and converting that into the internet. And anyway, what happened was a few years later they merged. Richemont and the VCs that had founded Ukes and still controlled the controlling stake, they all decided it made sense from an infrastructure, inventory control, delivery point of view. And so by following this situation, it started to teach me a lot of things about what could be different about these companies that start out with a dedicated architecture. And so we wound up investing in Ukes Net-a-Porter a few years later. What was actually the final catalyst was that we had invested in Jimmy Choo because it was sort of a special situation. It was 80% owned by its shareholder. It was listed on an exchange in a country where in the UK, where only a single-digit percentage of its sales were, and it had an interesting earnings growth story that had kind of been obfuscated by a lot of investments. But anyway, their key internet partner was Net-a-Porter, who in turn actually had a B2B service in which they were creating Jimmy Choo's own online store. And we looked at this and we said, how is Bergdorf Goodman on Fifth Avenue going to compete when the most important profit centers in that company are the couple of hundred elite personal shoppers with offices upstairs from the main store and enormous Rolodexes to try to cut these people out, even if you figure out a proper profit share where they will move their buyers online, just from an institutional momentum point of view, to cut that out, we just thought would be way too difficult. So anyway, the reason I kind of went on that long aside about Net-a-Porter is because it really our long arc with that company really nailed interest in food delivery, in Grubhub, and in Ocado. I remember in early part of the 2010s visiting friends in central London, ordering off of Ocado, and the convenience. And even at that time, it seemed like a more sophisticated service than we had in New York. Interestingly, Fresh Direct, which I have no financial interest in, it's a private company, but I am a happy customer, so it's not a paid ad placement. I happen to be. Fresh Direct has always been a much less sophisticated service than Ocado. And I could feel it when I was first coming into contact with Ocado with customers. Then an interesting thing tipped me off, which was that in 2013 they signed a deal with Morrison's supermarkets in the north of England. And if some of your listeners are Game of Thrones fans, then we would all have our conceptions of Northerners as tough people and canny people. And in this case, I actually had a dear friend in the business who in a prior life had been Morrison's accountant in the 80s and 90s and had huge admiration for the management. And when this deal was signed, he said to me, we need to look at Ocado as an investment now. And I guess I took a pretty cursory look, did meet with the company, did familiarize myself with them. They had already been public for about 3 or 4 years then. But it didn't make sense to me. It was sort of, Ocado reminds me of Amazon in one way, which is that if you look at the historical financials, these weren't, big money burning companies because the market would not support big losses. Some combination. We weren't in a permanent zero interest rate environment a decade ago. The fallout from the post 2000 TMT bubble collapse had made investors more cautious. Whatever it was with a number of these companies, as opposed to with some of the greats of today, with a number of these companies, they were not losing money. They were free cash flow positive for many years at diminished levels, investing enormously in the future, but not running losses and getting losses financed through capital raising because the capital raising just wasn't available. And if we, from kind of a U.S. centric, Silicon Valley centric point of view, can think of tricky periods for capital raising availability. I mean, it's a much more extreme example of that in Europe, and I think that makes for some tough, keen capital allocators with a very good appreciation for stretching dollars and not being dependent on financing. So so where do we? Anyway, a few of these themes were being pursued pari passu over a few years, and in 2017, I wound up coming back to Ocado. They were starting to do conferences in the U.S., and I had a chance to meet them over here. And this time, looking at the company, I thought it was a clear case that they were going after established industry and infrastructure, and that they were willing to make investments that these established companies were not. And in particular, their vision. And I see Ocado as having a twin vision of centralized and robotically automated distribution. But if we could leave aside the automation point, their original vision was centralized distribution. And of course, Fresh Direct was doing that here too. But centralized distribution is an interesting case to go after, because as opposed to the rest of the industry that wants to retrofit existing infrastructure, Ocado never wanted to do that. Ocado wanted to say, let me put high CapEx, and in their case, even higher CapEx because of the robotic automation. But just the centralization means enormous scale. It means enormous CapEx into one facility. And, but of course, it also means that it creates very good economics with incremental orders added, and it can create very good scale to the throughput.
Very interesting. And, there are a couple themes that I really love from your long arc with both these companies and the industries that you follow. And then you mentioned the parallels to Amazon. And one of the things I pick up on here with Ocado is that not only were they investing through the P&L like Amazon, but they also had built these tools for themselves to actually, be the supermarket for an end customer. But then at the same time, they were thinking about using these tools as a way to create new business models and help others do it. So maybe talk a little bit about that element here, and how long, whether that was a vision from the start with Ocado that they do this, build this out, and offer it as a service to others, and how the two business models kind of shape up within one company.
Here's a place where I think it benefits us to be flexible investors, and I appreciate in investing in certain markets, but I'm not a dedicated UK specialist, for example. I've invested there a number of times over the years. Ocado had been telling this story of having developed all these systems and being in a position to market it to other grocers for a very long time. And I suspect a lot of the negative view of the company came from the fact that they had been telling this story for a very long time. And so when we came to the company again in 2017, I think local market investors had seen them say for years, we want to market this to other companies. They had done a small sort of down in the Iberian Peninsula with Bonpre markets, but anyway, they had never, and then they had done some local deals in the UK, but they had never done this big international expansion that they had talked about. When you add in the Amazon deal to buy Whole Foods that hit in I guess it was early mid 2016, and led to a further bear attack on Ocado, which in retrospect is sort of a funny thing, because Whole Foods has 5 stores in the UK, great stores, but 5 stores, and Amazon is such a fantastic, such an incredible company that it's pursuing many important goals at all times, and boosting these 5 stores in this one country was not top of mind. But I think it was a case that great things take time, and ambitious plans. Ocado was founded in 2000, went public in 2010, and very soon after started to talk about how the systems that they had built had exportability and broader applicability. And it wasn't until November 2017 when they signed a deal with Casino Supermarkets in France that this started to materialize. And even then, that deal, it was a multi-year deal. It's a very long deal. It was a deal that they said could take up to 3 years to get running. They wound up launching the first site with Casino in the banlieue of Paris in April of this year. So a few months ahead of the schedule announced years earlier, and also at an interesting moment in the arc of the growth of the online grocery industry, for sure. But anyway, the point is, I think people, locally in the UK were kind of tired of hearing of this story and not seeing things materialize. Something that I've always enjoyed about being an investor in this company has actually been the enormous local chorus of naysayers. I think I think it's a combination of the quirky, sort of sardonic British humor that that even here across the pond, a lot of us love and admire, E.G. Woodhouse. And then I also think I think it's sadly that there aren't so many there aren't so many great scaled tech stories that have come out of the country, even given what a given what a comparable R&D culture it is to the U.S., but it hasn't had that that same stock market presence. There are some other great e-commerce companies, ASOS. Anyway, what that means is that, I mean, if you look at the coverage in the FT over the last decade, it's just been astoundingly snarky from my point of view. And Amazon has attracted admirers and detractors from the start, but there were always admirers in the press also.
Yeah, I mean, it's been interesting watching some of the, I mean, Amazon in particular has had admirers, but they've definitely had detractors. Ocado, I mean, you see a bear report on it every few months. It's weird to see a company like that attacked, but I think part of it, Henry Ellenbogen, now at Durable Capital, was at New Horizon at T. Rowe, talks about looking for companies who are small growth companies that have this Act One, where they're able to, get a toehold and build a nice growing business, but have built a platform where they could go on to an Act Two and kind of pursue line extensions and a much broader business model. So, I mean, maybe one of the things that people miss is the business model is even more advantaged, not being a supermarket that's thought of as how people get food, but a technology platform that could be kind of like turnkey built and licensed to other providers. So like, how does a business model differ in the two? I definitely think that's one of the areas that people get thrown off here.
You're exactly right that they basically totally transitioned their business model, where they went from 17 years of being an operator in the UK with one important partnership with Waitrose that was supplying a third of their products, to starting to sign deals. And then in late 2017, they signed a deal that I mentioned in France. Then in early 2018, they signed deals in Sweden, Canada. And then suddenly in mid 2018, boom, they announced that they were entering the US with a big deal with Kroger, and Kroger even made an investment with them, and suddenly it became apparent their focus. And within about a year later, they basically exited the retail business, and by that I mean they merged their retail operation with Marks and Spencer. They've kept a 50% interest. I think that they'll always want that 50% interest because it remains their testing ground for the technologies. But now the kind of key company is the solution provider, and it's selling its technology to their domestic retail subsidiary, which is a 50% subsidiary JV company, and also now selling in the countries I just mentioned, and also Australia and Japan. And so the real focus is now on supporting grocers in having an extremely efficient online presence as a full end-to-end solution, doing the from building the apps and taking orders to the truck routing and distribution, and then of course the kind of the key piece, which is their warehousing technology that leads to incredibly high asset turn, a very rapid velocity of inventory, and very low levels of waste because of the effect of the centralization. In the UK, they have a $3 billion sales business served basically out of 4 facilities, with a few intermediate facilities, but 4, massive scale grocery stores, and then further improved by the robotic automation. So incredible scale of centralization, and then just relentless focus on profit, on process improvement.
Yeah, I think in the show notes, we're going to have to share a cool video of one of the Ocado warehouses in action, because it's really neat seeing these little bins zip around a room and not collide with one another in the process. In a relationship with Kroger, like, who's putting up the CapEx to build one of these facilities? And, when I make $100 grocery order, how do the economics get divided up, or is Ocado really just getting paid on providing the technology there?
So there's investment upfront in the facilities by both parties that varies according to what market they're in. But when you talk about when you order a $100 basket of 40 grocery items, that is the grocer's revenue. So I look at Ocado as being they're sort of a futuristic ERP system that's on the hardware and software side, and so it's very deep level of inventory management and inventory physical movement, but they're very much a technology provider. So it's the grocer's sales, and they charge management fees, capacity fees to run this dedicated capacity that they build.
Yeah, and then now we find ourselves, so this all was being built and getting ready for what ultimately is one of the biggest accelerants and stress tests of the Ocado model with COVID, where everyone's forced to stay at home, and suddenly these industries are digitizing much faster than we'd ever imagined. So how has that pulled forward the future or changed your outlook and perspective on Ocado?
So the case that we always saw for Ocado was the efficiency that it adds to the grocery buying process. And in particular, I think of it as a stage 1 value proposition and a stage 2 value proposition. And the stage, and none of this has anything to do with the pandemic. So we'll get to COVID and a stay-at-home culture. But the basic stage 1 value proposition is convenience. And there are worries that people have that need to, people need to learn about the freshness and inventory control and why with days cut off of food's inventory cycle, you are getting a better and more efficient and therefore at the margin cheaper product. But there's really the stage 2 value proposition, which I think is much deeper but is unseen, which is the efficiency that this adds to the food sector by shifting to sort of a just-in-time inventory control system. And so, stage 1 is the marketing advantage, and that was what was affected by the pandemic. But the deeper stage of sense behind this business model is that by cutting out intermediate distribution points, the food industry has a higher turnover, has a more rapid turnover, and can have better prediction, better control over its inventory than needing to send out inventory to intermediate warehouses and then send them out to too many grocers. And in big cities, you feel this. I mean, in New York, I always say you can, when you walk into a grocery store, when you walk into any retailer in New York, you can tell when the merchant owns their real estate, because we wind up in a situation. I live in the East Village, and we have some hardware stores and some sort of standalone butchers that are like, still have wood chips on the floor. And, you can very much feel in some of these stores and in stationery stores that the proprietor of the store bought that person or a parent or grandparent bought the property, and the rental is not baking into the equation. When you get to the food industry, of course, it means that you're winding up with many different sales points, and you need to, and then at that time you either need to pick and choose what inventory you're offering. So those stores have a fraction of the SKU selection. You need to charge more to make up for the intermediate distribution points, or you need to have less fresh product when it's on the fresh side. And you must pick between those circumstances.
Yeah, when you say that, I think about like on the other side of the spectrum, there's a company like Instacart who's sending someone into a supermarket to like fetch individual pieces for you. And it's not really necessarily that different on the back end of the supermarket model. It's more about who's pulling the stuff together and getting it to your door. So maybe, I've heard you talk about in the past the various different models towards logistics and getting, groceries to the house. So what are some other approaches like Instacart, and what else? You mentioned Fresh Direct. How do these companies differ from one another? Who else is competing in this area? And what are some other companies you might admire taking this kind of trying to bring disruption to food delivery and logistics?
Well, first of all, you mentioned Instacart. I have an enormous amount of admiration for Instacart, but the admiration is about the business savviness of the management, the incredible speed with which they roll out and move forward services, but not with the core proposition of what they're offering. But I'll come back to that in a moment. You mentioned Fresh Direct also, or I mentioned that I love using Fresh Direct. Fresh Direct is this centralized model. Fresh Direct is quite automated. It's not as automated as an Ocado Hive, but it has good levels of automation, and it has good centralization, and it has extreme centralization, I should say. They operated for almost 20 years out of Fresh Direct and Ocado were both started right around 1999, 2000. And Fresh Direct operated out of Long Island City all these years. And then about 1 year ago, moved to the South Bronx to an interesting area that the city has very ambitious plans to improve. Anyway, Fresh Direct's one facility serves, Connecticut down to the DC metro area, which is of course a testament to the efficacy of order centralization. Ocado's first 4 facilities in the U.S. are going to be in Dallas, Atlanta, Cincinnati, and Orlando, Florida. Cincinnati is Kroger's hometown, and Dallas and Atlanta are competitive markets that Kroger's in. But Florida, it's actually Groveland, Florida, is a really interesting test case because Kroger is not present in that market. Kroger is building a facility basically in between Orlando and Tampa, a little closer to Orlando, that's going to be able to serve both metro areas, but that from a marketing point of view is going to need to, go for the jugular of Publix, a very beloved brand by Floridians. So it'll be really interesting to see if the value proposition that emanates from centralization and quality centralization, automated centralization, if the value proposition is such that they'll be able to have an effect on that market. So that's really, of the first 4 Kroger facilities that are opening in the next half year, that's kind of the one that I'm the most interested in seeing what comes out of there. But to come back to Instacart's management, there's some of these incredible people that saw a gap in the market and then just moved so rapidly to address it. And in particular, they saw a gap in the market that the industry did not see. And so grocers were not doing a good job at building up delivery capability, aside from, by the way, the largest grocer in the country, which is Walmart, which had already been testing out interesting things like pick up and go, like order in advance and pick up. But most grocers had not been testing out technologies, and the guys at Instacart and their amazing founder, they basically saw this and said, let's give the industry, let's put them in business overnight. But the thing that Ocado and Fresh Direct and believers in centralization would take issue with is that they would say that ultimately Instacart is a Band-Aid in its current form. Now, the fact is Instacart has become so big and so successful that they have incredible customer data, and they have their own forms of sophisticated technology. And so it'll be very interesting to. I've heard rumors that Instacart is. I mean, there's articles online that Instacart's ready for its IPO, and I'm sure coming off of the back of a pandemic year, the numbers, really, were really great this year, I'm sure. But Instacart is in its current iteration, it's a labor arbitrage. It's a gig economy company that's some people are willing to pay more for groceries, and there are people willing to be paid to go get groceries. The concept behind centralization is families are willing to spend the prices that they know on groceries, and people are not, aside from maybe some very privileged people, people are not willing to spend more for groceries, and therefore you need to find a way to have a relentless focus on cost, and adding a layer of infrastructure over the world's existing infrastructure is not cutting out that cost.
Yeah, that's really interesting. So, I mean, with COVID starting, I used Instacart for the first time. I obviously used it half dozen or more times since the lockdowns began. But it does seem like we're in this state of flux between a future world and today's world. Like, if you fast forward 10 years, do you think these two business models, these two approaches will coexist, or do you think everything's going to move the way of centralization?
I think that all retail, as we have seen, is in the process of needing to have relevance in the form of experiences and needing to not be afraid of e-commerce. If you are trying to control your customer, then then that's a losing proposition. If you're trying to serve the customer, then that's a winning proposition. A company that I admire so much as a customer and have been a shareholder of over the years. I know you guys had a good episode on Nike some months ago, and that's such a great example of a company that sees how important the internet is, sees that people like e-commerce, but then also knows the tactile nature of their products. And so, you go into one of the big Nike stores in New York, and you walk into a virtual putting ground, and they have treadmills set up with 270 degree wraparound, go for a run on the beach in Rio experiences, and they're not even pushing you to. I mean, you go into a Nike store, employees are just so happy and so friendly and have such a passion for the product, and must love the discounts on the product, and it's not. You're not getting pushed into buying anything there. You're getting information on the products, and the whole way that the company, I guess this flies in the face of what I opened with saying why Net-a-Porter is so much better than Bergdorf Goodman. I guess Net-a-Porter is better than Macy's and Bergdorf's because Macy's and Bergdorf's are not as good because Nike is, and Nike is not trying to control you. And same thing with Apple. They're Apple stores, Nike stores, Samsung stores are highly experiential. There's much fewer of them. There's one in the meatpacking district in New York. These are stores supporting a digital flywheel, and these stores are going to be around. Some of Instacart's business is coming from stores that are not going to be around, stores that don't provide nice enough in-store experiences for people to want to shop there, stores that either are habitually purchased and therefore still top of mind, or in some areas maybe the closest, in some areas that don't have as dense number of grocery stores as big cities. And then, for those stores to have Instacart shoppers for a while makes sense. But the way I see it, that's not a full embracing of e-commerce. That's not a full embracing of your customer to just serve them however they want to be served. That's just, a pretty basic level extension of what's already provided.
Yeah, that's really interesting. This idea that the store exists not to sell to you, but for you to experience and deepen your relationship with whatever it is that you're shopping for is really, a profound change, and it'll have big consequences for a lot of industries. When you're talking this through, I'm thinking like, what's going to happen with strip malls and real estate? I know that's a bit of a tangent, but I'd imagine there are pretty big ramifications. I want to go back to what you said earlier on about how you have this long arc with these industries and these companies you're involved in. And I know there are other places that you've gone now informed by your experience with Ocado and with food delivery and logistics. Maybe talk about some of these other opportunities and what you've seen and how you ended up getting there. I know there's some really interesting ones.
Well, it definitely pivots off of what you just said about, what is the effect going to be on strip malls? What does it mean for the future of commercial real estate? Because we see the effect that e-commerce has had going from nothing to 15, 20% of markets. And, it's a pretty reasonable bet that a decade from now, there'll be another doubling, because certain product category. First of all, a lot of older generation people learned e-commerce during the pandemic because it suddenly became relevant to them in a way that it never had. But then you have a lot of younger people that, particularly for a lot of product categories, have never had the experience of going and buying it, and they're not going to suddenly learn to buy certain items offline that they became consumers of in an online. So, an interesting company that or I should say, an interesting market that we've come across for this is Hong Kong, where I lived for 5 years, and very much love the city. It's incredibly crowded and exciting, and incredibly beautiful nature. It's one of the, I think it's the only place I know like it, where you can be on Connaught Street, which is Wall Street of Hong Kong, and get in a taxi, and 15-20 minutes later you can be kayaking in the South China Sea. So it's a very varied it's a very varied environment. It is a place that for the longest time had the most remarkably low penetration of e-commerce, and there's different reasons for that. It has one of the highest real estate costs in the world, maybe the highest, and so many people live in very small apartments, and people like to get outside, and the weather is extremely clement year round, and so every neighborhood has all sorts of stores, and so the e-commerce penetration was incredibly low for all time. A company that interests us that's changing it is sort of the Ocado of Hong Kong. It's called Hong Kong Television. The name is a nod to a prior incarnation of the company, in which it was trying to buy a TV license from the government, and they wound up in a sort of protracted dispute over buying the license. The CEO, the founder CEO, is extremely famous there. He's kind of viewed as an outsider type of manager. And anyway, over the last half dozen years, they transitioned their business. It had originally been in telecom, then in TV. They transitioned their business into e-commerce and grocery e-commerce. They're different from Ocado in that they're a hybrid 1P and 3P logistics model. So many small vendors have stores over the HKTV Mall, which is their site. But the basic concept is that Hong Kongers want to shop online also, and so they went and they built all this infrastructure, and they have very sophisticated levels of automation in their warehouses that are all around the SAR. I say that they're, to me, the company that's interestingly unautomated, and I can tell you is Amazon. And when I look at Amazon's lower level of automation, to me, there's the one clear reason, and then I have my one little conspiracy reason. The clear reason for Amazon's low focus on automation is that Amazon is such an incredible company, so far ahead of everyone, so far ahead of the US e-commerce landscape, that is not where they need to invest in order to stay ahead. And they're already so far ahead of competitors, that incremental dollar spent, and they talk about incredible capital allocators. People forget Amazon only raised equity capital twice. It did a tiny IPO in 1997, and it did a big for the day follow-on primary in 99, and they never sold stock again. So these are incredible capital allocators, and they see fit to spend that incremental dollar on marketing and on developing more predictive technologies for shoppers, and on on all aspects of their business. My conspiracy theory for why they haven't automated so much is that being as successful as they are, clearly they are, probably the most political and polarizing company. And, I remember when they were coming into New York and local politicians were upset and too much is being done for them and all this. And so I think they find it useful that, you can pick a random state and there's a decent chance that they'll have, 10 or 20,000 or more employees. And, that can be a very good thing if a state is, if New Jersey isn't happy with them for some reason and they say, yeah, well, 25,000 New Jerseyans work for us. So, be gentle on me. Anyway, so, when I look at Hong Kong, the level of automation is even beyond an Amazon, maybe not quite at the level of an Ocado. Now, what was interesting was people were very skeptical of this model for a long time, even though the company was growing at 40, 50% a year, their GMV for years, even though thanks to their prior incarnation as a television company, they have very good television studios and they've done very innovative things on the side of home shopping and media. And they brought a very exciting offering on the marketing side. It sort of took this pandemic year, and in this pandemic year, I guess two things happened. First of all, their GMV, they report monthly numbers, extract abbreviated numbers. Their GMV is going to be up around 120% for 2020 over 2019, and they disclosed in June or July that on a net bottom line basis, forget about any adjustments to any numbers, they are fully profitable this year, and and at a reasonable level of a few percent on GMV, which is a good margin on concessionary fee for 3P business or on gross profit for 1P business. And it's interesting to see. And the stock has kind of continued to trade as a COVID stock. And by that, I mean, although it's performed strongly this year, as of course it should, since the fundamentals have been great. It's also had interesting periods of weakening, including recently when the SAR was opening up again. And I look at it like, who wants to? Once you realize the magic of getting of getting stuff delivered, and you see the quality, freshness, prices, and convenience, and then you sort of bake in. Then you bake in. It can be tough when people are paying their own way to go get things and putting a modest amount of gas in the car, taking 15 minutes to commute, spending a half hour somewhere or an hour waiting online, then coming back. It can be tough to kind of value the time, and it's like, that's just part of the shopping experience. And maybe when the only alternative available is some very fancy service like Instacart, and they're specifically saying, well, for this $100 basket of groceries, will you pay $120? You might say to yourself, I don't know, what's my time worth? I don't know how to calculate it exactly. And I already have this habitual thing where, I go to the grocery. Once that kind of all gets ripped apart because you're scared to go to the grocery because you don't want to be out extra. And if you do want to be out extra, it's because you want to be, doing something fun. And then once it works its way through and you see, wow, it's sort of the same price, same freshness, same quality. It's a better selection. Maybe you notice it's even a little bit better quality at the same price, suddenly your bearings get reoriented.
Yeah, that's really interesting. And then you come to think one of the things I've been really focused on. So you said their GMV growth rate effectively doubled. You think about this business model, it's obviously got to be like pretty high fixed versus variable costs. So the incremental margin is high. That's where profitability comes from. So now you have a company that's got way more resources to invest going forward than they had in the past. So where are they going to invest? Is it more going to be in, customer acquisition, or are they going to do they have levers to pull on kind of enhancing their level of automation? How does that go from here?
Well, I look at the size of, there'll be a little under $1 billion in GMV in 2020. Far and away the largest in online, but in a region of 7.5 million people that has one of the highest incomes of anywhere in the world. So they have so much to grow locally that there are enormous retailers in Hong Kong, and I think that they have not had to adapt, and they are going to be forced to have some sort of a reckoning, whether it's by this company or by another. But interestingly, in the case of HKTV, they've announced in some local interviews that the founder Ricky Wong gave, he mentioned how inspired he had been by Ocado, and then they've actually announced that they have approached regional cities about trying to partner with providers. Now, once you start moving out Hong Kong is this protected little place. Once you start moving out in Asia, you generally find one of two things has happened. One of three things, I should say. Either you start looking in a place like Taiwan or China or Korea, and there are some very, very strong incumbents already. These are places with incredible e-commerce present. Or you find regions where China has tried to make inroads. So where large Chinese companies have tried to make inroads. So in Thailand, their big retailer, the Central Group, Jindu, JD.com did a deal there. In Southeast Asia, Alibaba had been the leader and had been the first mover with some tough competition in Indonesia, but had kind of been ahead with its Lazada brand. And then a company that we had made a small investment in a couple of years ago because it was still a ways away, has really grown into a special thing, which is Shopee, which is the e-commerce brand of a Singapore company called C Limited, listed on NYSE. But then the third thing that you encounter. So the first thing is, if HKTV tries to go overseas, they're going to encounter strong incumbents. The second thing they're going to encounter is some big partnerships if Chinese or Japanese companies have tried to enter markets. And then the other thing is that there are a lot of regions that are very promising, but that do have very large populations, including many much lower income people. So for example, I mentioned that JD had gone into Bangkok. This should be an amazing market because Thailand is an economic powerhouse of a country. Bangkok is an extremely wealthy city, but Bangkok has also had a nonstop migration into the city from the countryside for since World War II, and it's ongoing. And so it does mean that Instacart model that I mentioned, of just retrofitting existing infrastructure, that could have a much longer tail in a city like Bangkok or Ho Chi Minh or KL, because because it is much easier to hire to hire shoppers and to hire support. But even there, I think that the centralized model makes a ton of sense. And Bangkok, KL, these are cities with enormous affluent populations. I mean, many millions of upper middle class people.
Yeah, it's so interesting how you've thought about this from many different angles, being, the various business models starting in the developed world, in the UK, the US, and then thinking about it globally. So HKTV, it sounds like a second act might be a little tougher in going international, but do you think they have, I guess the runway seems long enough in Hong Kong itself that they could keep going for quite a while?
Elliot, I will tell you this. We can talk about the long path we've had with Ocado, but when we invested in Ocado first, it was just predicated on what they were doing in the UK, and it sounded credible and it sounded interesting what they were going to do overseas, but we were not, we didn't have the vision to bake that into the valuation, or would have been my only HKTV is the same story. We are investing in this company based on what they are doing today in their home market, what the path, what we see that could be. It will be incremental if they develop any of these other things that they're talking about, and we're certainly watching very closely.
Yeah, that makes sense. And then, I want to be mindful of your time here. If I could ask one more question about this whole space. So we've talked about kind of the new upstarts, but who are some of the companies that you think are, and I mean, I guess some of these come to mind just off of what you've been saying, but who's not well positioned for the future of the world? What are some legacy companies who you think really have to either kind of revise their strategies or change their approach, or, who's going to be the most disrupted companies here?
Well, so the grocery space is definitely going to become much more consolidated as it shifts online. And so the best big players that are doing great things in the e-commerce space, like Kroger, like Walmart, are positioned to take share. On the other hand, you've started to see interesting movements at the smaller end of the space of clearly very canny business people who understand that they're not positioned for that shift. And I guess two examples in the New York area I would highlight would be King Cullen Supermarkets of Long Island, which was around 36 stores, around 100 plus year old family business that had been public decades ago. The family had taken it back over, sort of a beloved chain in Long Island that a year ago quietly said, we're done. And they sold to Ahold, the Dutch supermarket giant that is extremely important in the Netherlands, but that's actually the third or fourth largest player in the US. They're around the same size as Albertsons, Safeway. And Ahold in the US owns Stop and Shop, Giant.
Lion.
Which?
Food Lion as well, right?
Something Food like that. Lion, Hennepin, a lot of brands up in the Northeast. The Cullen family made this decision that this golden goose that our family built up over 4 or 5 generations. Let's exit because we're not going to make the investments required. In New York City, a major local businessman, John Katzimatidis, who has Gristedes and D'Agostino's grocers. They have slowly exited the business. In South Brooklyn, they built a very they have a very impressive kind of mixed commercial facility that came out of a grocery store that had expanded. Because I think that the history that you have with a lot of these companies is that for a long time these local grocers were sort of local monopolies, because whether you shopped yourself or you had someone, or a family had someone they would send to do the shop, whatever it was, you were constrained by geography, and so these were very good businesses for decades. And then it made sense to own the real estate because it would be a long-lived. You're not going to move it; it will be there as long as the neighborhood is there. So I don't think that those I would say that those businesses that I just mentioned, King Cullen and D'Agostino's, would be poorly positioned, but they're not poorly positioned because they are transitioning their businesses. So I think that there's going to be today. Walmart is around 20% of our market in the U.S. It's just a third of Walmart's business is their U.S. grocery business, but it's around 20% of the U.S. grocery market. Kroger is the next largest, is around 2/3 that size. Albertsons, Ahold, and then there are some regionally very strong players that have very high shares. H-E-B in Texas, Publix. I think that for the kind of regionally dominant companies that transition well, they're in a really great position because they have marketing advantages, they have sourcing advantages, and the last piece is they need to be like Nike and really embrace giving the customer what they want and not try to micromanage the sales channel because, this is a little more profitable today, or we're a little more experienced at it and we don't want to devote the resources to needing to do that. But yes, we are looking for interesting shorts that are not positioned like that and that can potentially be left behind in that middle.
That certainly makes sense. Well, Isaac, this has been a fun and fascinating conversation. Thank you so much for sharing your wisdom on this industry that literally touches our lives every single day. So, really deep and insightful and global. So thank you so much.
Thank you, Elliot.